The capital asset pricing model defines beta as the relationship between the market return and the return on an individual asset. So let's go back to our portfolio and look at how beta is calculated. And here we have Apple stock, and for the market return we're going to use the S&P 500 as a proxy. Of course, market return should include all traded assets, but it just happens to be that the S&P 500 does a pretty good job of capturing the total market return. So if we look here on the horizontal axis, we have the returns on the S&P 500 on the x-axis, and on y, the vertical axis, we have the returns to Apple stock. So for each day, so for example right here, this was a particular day when the S&P 500 returned 6.21% and Apple stock had a return of a minus 14.41%. And up here, this particular point in time, the S&P 500 had a return of 2.8% and Apple stock had a return of 23.77%. And if we plot all these data points, so this is over the last several years from February of 2007 to January of 2017, this is the data that we have, the monthly data. These are all those monthly data put on what we call a scatter plot. And if we look at the scatter plot, you can kind of vaguely see there's a relationship between Apple and the market that tends to go up. And we can fit a line to describe this relationship. In other words, to best fit this scatter plot. We can do that a couple of different ways. But here we're just using regression analysis to calculate that. And that line kind of captures the relationship between Apple and the S&P 500. And the slope of that line, recall back from high school, the slope of a line is rise over run. That rise over run, that slope of the line, that is the beta coefficient. So when we let Excel run a regression for us, it tells us that the slope of the line is 0.7666. So the beta for Apple stock is 0.7666, at least using monthly data over our 10-year period of time. The market explains this R squared about 23% of the variability, the variation in Apple stock. Let's look at another company in our portfolio, Berkshire Hathaway. Berkshire Hathaway, we do the exact same thing. On the x-axis, we plot the returns on the S&P 500, and on the y-axis, the up and down axis, we plot returns for Berkshire Hathaway Class A shares. And we can see when we fit a regression line, we see a relationship, and just looking at it, you kind of see a weak relationship between Berkshire Hathaway Class A shares and the overall market. And the slope of that line we get when we run the regression in Excel is 0.38. So we would say that Berkshire Hathaway Class A shares have a beta of 0.38, and because the average stock has a beta of 1, in other words, the market has a beta of 1, we would say that Berkshire Hathaway is a less than average risk stock. And then we can calculate the beta for our portfolio as a whole. Now, as we perform that portfolio, what are we doing? We're getting rid of diversifiable risks. Now, we're not very well diversified in this portfolio because we only have 10 stocks. However, you can already see that by forming a portfolio, we got rid of a lot of the variability in the individual stocks. So for example, if you see this dispersion in Apple stocks quite large, and the dispersion in Berkshire Hathaway quite large, but when we look at our portfolio, we can see these dots, the individual data points, are lining up much closer to our regression line, our beta line. So the slope of this line is 0.60, so we would say that our portfolio had a beta of 0.6. Again, the average stock has a beta of 1, the market has a beta of 1, so we'd say our portfolio has less than average market risk. Now notice that when we calculated this regression, plotting the returns of our portfolio against the S&P 500, we have a 0.6 value. So from the scatter plot, we saw that our portfolio had a beta of 0.6. We can also calculate the beta for each one of our stocks. So again, we saw beta for Apple was 0.77, just dropping this to 2 decimal places here. Berkshire Hathaway was 0.39. And again, I strongly urge you to open up the Excel spreadsheet, see how these values are are computed, and we see Caterpillar has a beta of 1.28. Does that make sense? Yeah, Caterpillar is very sensitive to the market, what's going on to the market. Berkshire Hathaway and Apple, less so. And if we look here, one of these stocks has a beta of 0.28, Coca-Cola. Yeah, not very correlated with the market. Again, what we would expect, people probably buy their soft drinks no matter what the market is doing. And we can see all the betas here for AT&T. And if we calculate the beta of the portfolio, as we saw before, it's about 0.6. But if we were to take the average of the betas that are in our portfolio, take that average, again, this is an equally weighted portfolio, it would exactly equal 0.6. So we can arrive at beta two ways. We can just calculate the regression directly and come up with a beta of 0.6, or we can calculate the betas for all the stocks in our portfolio, take that weighted average, and come up with a beta of 0.6. And now that we have some betas, we can calculate the expected return under the capital asset pricing model. And the first thing we have to do is come up with some estimates for risk premium. So going back to our data from 1988 to 2016, we saw the S&P 500 had an average return of 8.91%. 10-year Treasury bond had a return of 4.8%. So we could calculate a market risk premium by taking the difference between the S&P 500 return of 8.91% and the 10-year Treasury bond 4.8%, come up with a market risk premium of 4.11%. And if we want to kind of see how stable this is, we can look over just the last 10 years from 2007 to 2016. We see that risk premium is about 4%, so a good estimate for a market risk premium is somewhere around 4%. So applying the beta of 0.77 for Apple, the capital asset pricing model would say that the expected or required return for holding Apple stock is 7.95%. So we are applying our basic capital asset pricing model that says what? And again, you can look at the contents of that cell. It says it's equal to the risk-free rate, 4.8%, plus a risk premium. And the risk premium is the beta, 0.77, multiplied by the market risk premium of 4.11%. And then we could calculate the assets risk premium simply as the difference between the capital asset pricing model's total return of 7.95% and the risk premium of 4.11%. So an investor would require 3.84% above and beyond the 10-year Treasury bond for investing in Apple stock. At least that's what the theory says that they should expect to get compensated for taking on that diversifiable risk. And we can see what, for all of our stocks, the capital asset pricing model, what it says the return should be. And as well here for our portfolio, the capital asset pricing model says our portfolio is required to return 7.27%. And just for grins, I calculated the geometric average annual returns. And what do we find? That over this 10-year period of time, from 2007 to 2016, that Apple stock returned about 27% per year on a geometric, and the expected return was 7.95%. So if you'd have bought Apple stock 10 years ago, you'd be very happy because you got a rate of return much higher than what you expected based on its risk. Likewise, you'd be happy, not as happy as the Apple folks, if you had invested in Berkshire Hathaway, because the average annual return for Berkshire Hathaway over this period of time was 8.76%, whereas its required return based on its exposure to non-diversifiable risk, the capital asset pricing model, is 6.39%. So it did quite well. Caterpillar didn't do quite so well, right? Based on its riskiness, it should have gotten the required rate of return of 10%. However, over the last 10 years, it only got 7.04%. In our portfolio had a expected return of 7.27% according to the capital asset pricing model, and it did quite well. It actually earned a return over this period of time of 11.62%. We could also plot the security market line. The security market line plots on the horizontal axis a stock's beta, and on the vertical axis its expected return according to the capital asset pricing model. So we can see for our stocks in our portfolio, they all fall exactly on the capital asset pricing line, the security market line. So for the market has a beta of 1, and the market, as we saw, had an expected return, required return of 8.91%. And we have some of our individual stocks in here as well. And what the capital asset pricing model says is that at equilibrium, in other words, there's no new information to drive stock prices, at equilibrium, that the expected returns for all securities will fall exactly on the security market line. And the reason for this, imagine if you will, we had an asset that had you do your analysis and you think, hey, I think this stock is, I've looked at their products lines, their marketing, and whatever data you want to look at, and you come up with an expected return on this stock somewhere in this neighborhood right here, which is below what the security market line says investors should require. Well, would you want to buy that stock that, say, is only offering a 6% return when based on its risk it should be getting close to an 8% return? Of course not. In fact, if you had that stock, you would sell it. And so would everybody else. And if everybody's selling the stock, what's going to happen to the stock price? It's going to fall. If you buy something for a lower price and you keep the future price the same, the lower your purchase price, the higher your return's going to be, or at least higher your expected return's going to be. The buy low, sell high. So as everyone's selling the stock and its price goes down, its price is going to fall down to the point that its expected return rises so that it falls exactly on the security market line. Likewise, if you had a stock that was, say, right up here, and it's like, wow, this stock we expect to get a 9 or 10% return, and we only require a 6.8% return according to the capital asset pricing model, that's a good buy. And you'd want to buy that stock. Well, so would everybody else. And eventually, the more you pay for something, right, your return's going to go down. So the higher price you pay today, given a set future value, the lower your return's going to be. And the expected return will fall as the prices rise, so the expected return falls exactly on the security market line. Notice that the slope of this line, the security market line, the slope's right here, 0.0411. That slope is the market risk premium, and the intercept, 4.8% right here, that's the risk-free rate. So what this is saying is everybody expects to get at least the risk-free rate plus a reward for taking on systematic risk, and systematic risk is measured, or non-diversifiable risk, systematic risk, same thing, is measured by beta.